Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, whenever we talk about investments, one product that usually stands out is life insurance policy. No other investment option can really replace this age-old product, which offers protection against possible life-threatening risks. But life insurance continues to follow the push model, which really means that insurance policies are sold instead of being purchased by customers. While this strategy of marketing insurance products is effective to get customers, the real purpose is defeated, as those purchasing the policies may not get the best life insurance product based on their profile and need. So in today's episode, we are going to talk about life insurance at length and importantly learn about ways to safe-proof our investment by opting for the right insurance policy. Let's welcome Naveen Kukreja. Welcome to the show. Group CMO, Policy Bazaar. Naveen, run us through the kinds of insurance policies that are available for customers to buy.
Hello Arjun. Basically, if you look at from a layman's perspective, there are two kinds of insurance policies. One is a term policy, which is essentially the simplest and purest form of risk protection. It covers you for a certain amount, and in the eventuality of untimely death of the life insured, it covers the dependent's family, the dependents of the sum insured to the amount that's been insured. So basically, it offers protection to the family in case of an untimely death. There are versions of term insurance, like lump sum. You cover for a certain amount and that's provided as a lump sum to the family, or you cover for a certain amount and that's given away as an income. We will talk in more detail about that. Or you get the cover back in case you survive the period. Besides term, the other part of the insurance policy is essentially which has risk cover combined with a savings option. Within that also there are two types. One is which is linked to market. It's called ULIPs. It's linked to market, like I said. You have different options of investment, from an aggressive into equity or to safer into debt investments, but essentially everything is linked to market, so there is no guarantee of any returns. Over a longer period of time, they tend to give a higher return, and now some of the ULIPs, like we talked about in the last show, are really low cost. The other option besides ULIP, which combines savings and protection, is something called as traditional in layman terms, but there are other names like endowment, etc.
Right.
Basically, they have a more or less guaranteed return to you for after the term of the policy, which is which either 10, 15, 20 years. They are typically they have a sum assured linked to that, but typically would offer returns in the range of between 4 to 5.5% over a period of lifetime of the policy. So low returns but guaranteed returns policies. Besides these two types, there are certain insurances which are linked to consumer needs, like a child insurance plan, which have benefits linked to that particular need.
Right.
Like a child insurance policy would have benefits in case of your death, benefits going to your child when he or she becomes an adult. Till then, it can stay in a particular fund.
Right.
Products like pension products, which are again geared towards retirement protection, which will have an annuity linked post your policy expires. Annuity linked to that, you purchase annuity, and then that provides as a regular income source.
Right. So would you say that ULIPs are for the more aggressive profile of investor, and the traditional, you talked about traditional kind of life insurance plans, for the more conservative investor?
So if I were to take a slightly extreme view, I would say that ULIPs are for each kind of investor. You can choose, because you can choose the fund options, the fund that you invest in. If you are an aggressive type and you have a longer horizon, you will go for an equity linked fund. If you are a balanced type, you will go for a balanced fund. If you are a more conservative type, you will go for a conservative fund which invests only into money market instruments, which is relatively safer but will give you a lower return over a period of time. Traditional policies, in my mind, are not a good option from a consumer perspective, because the returns are typically lower. If you are risk averse, I would say go for ULIP and take a secure fund or a conservative fund option.
Right. So, you touched upon term insurance. These have certain advantages. They are pure life insurance products. The premiums are significantly lower than the ones linked to savings plans, if I understand it correctly. Now, how does one go about choosing the right term insurance plan?
Arjun, just before choosing the right term, I think the first question that the consumer should ask is that how much term insurance cover
Right.
to go for. And the rule of thumb there is that between 12 and 15 times of your income, and I'll try and explain how and why.
And that's the annual income. you're
Annual
talking.
income. So if your let's take a scenario. Let's say your annual income is 7 lakh rupees. 1 crore is about 14 times your annual income. The reason I say 14 times is because if something were to happen to you and you are the only bread earner in your family, then your family would get 1 crore. Let's say your family invests that into a fixed deposit. Typically the interest rates on a post-tax basis would be between 6 and 7%. So they'll be able to get about 7 lakhs as an interest income, which is essentially your income. So that ensures that their lifestyle remains more or less same. They don't have to struggle in your absence, and that's why I say broad rule of
So you have
thumb
that
is-
nest for your family even if, something
Yeah.
happens.
Yeah. So broad rule of thumb, 12 to 15 times your annual income. What you can do is you can add all your liabilities. So if let's say you have a home loan worth 25 lakhs, so you will add 25 lakhs to that 1 crore and the cover amount will become 1.25. However, if you have current savings pool that you already have, let's say you have 10 lakhs in an example, you will subtract 10 lakhs from that. So your net need is 1.15 crore in this example. So once you're clear on that, the second important question to ask is that, am I confident, do I want a lump sum return or do I want an income based product which will give an income to my family on a regular or
So
a
what you're
long-
talking about is staggered payments
staggered
of
payments, absolutely. And again, that's essentially from the need for that emerges from the fact that whether you're confident that your family in your absence can manage a lump sum amount and can utilize it well, or you would rather the insurance company manage that and provide a certain amount of income for a certain period to your family. So that defines on whether you go for a lump sum or an income based plan. Once you're clear on these two questions as a consumer, then you decide on how to choose the right plan, which is essentially whether to take an online or an offline plan. In my mind, we will probably talk about it later. Do not look at offline plans. They are typically much more expensive. Look for offline plans. Again, look at a comparison site like ours or look at the insurer's sites for knowing more about the plan and the costs of that. Choose the term wisely in terms of how long are you looking to choose the term plan for. And then essentially see the premium, and you should be able to afford the premium. And essentially these are the things that you look for before choosing the term plan.
Right. Now, from experience, one knows that a lot of people have this huge apprehension in buying a term plan. And the first thing they say is, it doesn't give me a return. Right. And so even though it's pure life insurance, it gives a huge return if something happens to you. There is that apprehension. So what advice would you give people? And from a personal point of view, we had a tragedy in the family, and term plan is what really worked.
Yeah. As you said, once you've experienced something, and I've seen quite a few people I know who had tragedies in the family from a the bread earner kind of passed away, and they didn't have adequate term insurance, and you have to see the drastic change in lifestyle, the drastic change in the ambition for the children or for how you live. Kind of just tells you that term insurance is very, very critical. In fact, I would suggest that from a financial planning perspective, that's the first product that you should have. After that, you should think about investments and
build your investments around that once you've invested that. And it's not too expensive.
It's not very expensive. From a cost perspective, the example that I give, that for example, for somebody earning 7 lakhs, if you take a sum assured of 1 crore, which is 13 times your annual income, which is what will be very, very useful for your family, the cost of that is only about 1.5% of your annual income. So the cost for a 30-year-old would be typically about 10,000, which is about 1.5%. So there is no other product in the world.
And it's completely tax deductible.
It's tax deductible, so your actual cost is actually lower than what you're paying depending on the tax bracket.
Right.
There's no other product in the world which offers 13 times your annual income protection at the cost of 1.5% of your annual income.
So now a lot of people are actually buying term insurance plans online. So what are the pros and cons of buying it online versus offline?
So the biggest pro right now is the cost of the online plans versus the offline plans. If you look at some of the typical products, the online products are much cheaper. The offline products are actually between 3 to 4 times more expensive than the offline products. That's happened primarily because the insurers have found a need to promote term insurance, and also they have managed to cut down a lot of distribution costs which are necessary in an offline distribution mechanism or infrastructure. All of those costs are stripped down, so all the benefits are passed to the consumers. So cost is one of the big factors. The other factor is that when you're buying online as a consumer, you see the product yourself, you read about the product yourself, you know the term you're buying for.
So those are some of the things that you need to keep in mind while buying a term insurance plan.
Buying a term
online.
insurance, and if you buy it online, you necessarily see it for yourself, and there are much lesser chances that you missold a term insurance or insurance
and you
product.
get all the entire paper trail, and you get your document, because a lot of people say, oh, if I buy it on the net, I'm not going to get my document.
So it's absolutely same. There is no difference in an online and offline plan. The benefits are the same, the conditions are the same, the documentations are the same. The insurer would still give you the copy of the insurer. You get to see everything in black and white before you buy. So there's absolutely no difference in product in terms of the features or benefits. The cost is much lower, and you can see the benefits and the charges in black and white in writing. So it's absolutely I mean, it makes sense to buy online.
So let's talk about the concern that people have, and also in the industry, about mis-selling of different insurance plans, and what is the IRDA doing to counter that and to make sure that people get the right plans that they are looking for.
Sure. So IRDA has been taking a lot of steps since 2010 onwards, where they've been trying to kind of make it more and more consumer friendly in terms of all the products. So they have taken steps in limiting the charges that insurers can charge. They're taking steps in terms of promoting renewals or persistency of the products. They're taking steps and encouraging insurers to cut down on the costs and promote channels like online channels, which are cheaper from a consumer perspective. However, like you said, mis-selling does remain an issue. It remains primarily an issue in more savings linked plans. If you see, term plan is a very simple plan and has lesser chances of mis-sell. That's one of the other reasons that it's easier to buy online, because consumers understand it very easily.
Right, Naveen, it's time for a short break. We'll continue this discussion further. We'll also take your questions, but you can tweet us your questions if you have any concerns, if you have any ideas that you have, on Twitter at policybazaar_in. You can also email us at queries@policybazaar.com. And with me is Naveen Kukreja. Naveen, we've been talking about insurance plans, we've been talking about term, we've been talking about ULIPs. What are staggered based payouts of income?
So in a term plan, there's been these new products that have come in the last couple of years, which essentially, instead of giving a lump sum, which was the term plan earlier, that something happens to you, your family gets a lump sum amount. Now there are options where you can get a staggered income based payout. So I'll give an example. So for example, you take a 1 crore sum assured in a lump sum term cover. If something happens to you, your family gets 1 crore, and then the family needs to manage the funds and hopefully earn enough to kind of manage their lifestyle. In a staggered income based payout, an example of that would be that instead of getting the full 1 crore, the family would get 10 lakhs upfront to manage certain costs, etc. But they will get 6 lakhs over the next 15 years, 6 lakhs each year for over the next 15 years, which serve as an income and essentially kind of serves as a regular income for the family for the next 15 years and takes care of them.
Right. What about, we've been talking about upgrading of insurance policies. First of all, what does that term mean? And also, is it important to revise the policies that you have, relook at them, re-strategize? Because that's part of, taking care of oneself, one's family.
Absolutely, it's very important. What I would suggest to my consumers is that every couple of years you should look at what insurance policies do you have, how much cover do you have, because what happens is the needs changes over a period of time, the dependents change over a period of time, and your income and a lifestyle changes over a period of time. So for somebody who is just married, has one dependent in the form of wife, and has certain needs and expenses, but 5 years down the line, once you have kids, you have certain different expenses, certain different needs, you're thinking about their future. So your needs and dependencies have changed, and so has your income. So for example, somebody earning 7 lakhs or 1 crore sum assured might be good enough, but 5 years later, if your income has changed from 7 to 14 lakhs, and so has your lifestyle and expenses, then you might need a cover of 2 crores to generate a similar amount of income. So it's very important for people to look at and review the cover that they have, and they can keep upgrading by buying typically additional plans for the difference.
Right. So keep looking at your plans, keep revising those plans. It's now time for your questions. We've got Sherry. She wants to know whether it's important to disclose about running policies while she purchases a new policy. She's planning to opt for a term plan from HDFC Life and already has a term plan and 2 endowment policies from LIC. Does an insurance company have the right to deny or reject a claim of death, she asks?
Sherry, first of all, a good decision on buying a term plan. It's absolutely essential to disclose all the insurance policies that you have, because the insurer uses that information to determine what is the risk or the cover that they want to you to opt for, or they want to allow for you, which is part of their risk underwriting. If you haven't disclosed this information at the time of applying, that's a ground for insurers to reject your claim later. So absolutely declare all the insurance plans that you have.
Right, we've got Rohan Mathur, who's 26 years old, a sole earning member of his family. He wants to invest in life insurance plans that doesn't cost too much. What advice would you give him?
Rohan, the best and the first plan that you must go for is a term plan. If you're a single bread earner, like you mentioned, for your family, look at what's your income, and like I said, go for typically a cover between 12 to 15 times your annual income. So if your income is 5 lakhs, go for a cover between 60 lakhs to 75 lakhs. That's the best investment you can make for your family in case something unfortunate happens to you.
Right, we've got Rajat, who's 30 years old, has been investing in short-term investment instruments such as mutual funds. Now he's planning to invest in life insurance plans and wants to know if investing in a term plan is a good idea. I think it's an excellent idea. Naveen.
Rajat, a couple of points. One, mutual funds is not a short-term investment plan. Don't look at it from a short-term perspective.
Right, absolutely.
It may not give you returns all the time. Look at it from a longer-term perspective. Secondly, term plan, like I just said, is probably the best investment you can make for your family if something happens to you. So absolutely go for a term plan which is appropriate for your income and family needs.
And at 30, it's a great time to get in. You'll probably get a really low premium.
Absolutely.
Unlike me, who bought it at 40. But the next question is from Shivani, who says that she'd like to purchase an insurance policy online. However, she's a bit apprehensive about taking it forward, as it is not easy. She says no one helps you. Plus, there is always a question of credit card, debit card frauds. She wants to know how she can safely buy an insurance online. Now, that's a concern that many people do have.
Shivani, so that's a concern a lot of people had, before the e-commerce kind of really started picking up 3-4 years back. Right now, Shivani, there's absolutely no reason you should have any concern in buying a policy online. The policy is the same, the costs are cheaper, so it's actually beneficial. Of course, you do have to do some research on your own, which is actually good for you in the long run, because when you're depending on an agent or a bank to tell you about policy, you don't know whether it's the right thing or not. So do that research. It's not very difficult. If you go to a site like Policy Bazaar, you can compare different options. We also have a 24/7 customer assistance, so you can speak to the customer representative, or you can speak to a customer representative of an insurance company to clear all your doubts that you have and buy the right plan for yourself. As far as credit cards or debit card frauds are concerned, in my mind, there are as many frauds that happen because of offline purchases. If you go to a shop, you don't know when somebody's scanning your card, what are they doing with it. So the risks are similar. The payment happens at insurance companies' end, so there is actually no concern from that perspective, because insurance companies are governed by regulators and they are adequately capitalized. So you shouldn't be worried while buying online insurance policies.
Thanks once again, Naveen, for joining us on the show. But you can also tweet your queries to us at Twitter at @PolicyBazaar_in. You can email us at queries@policybazaar.com. And we'll see you next time with another episode of Policy Bazaar. Goodbye.